right. Well, hey, welcome back to the closing room. I'm your host. I'm Jesse. I'm a realtor and investor with the Moreno Group, and thank you everyone for joining us today. As always, before we introduce my guest, and I always tell people, look, if you're thinking about buying or selling a property, and you feel like you're, drowning in these confusing headlines and conflicting advice people give you out there, which is kind of crazy, you've come to the right place here at the closing room. We're all about straight talk, zero fluff, and real world advice that you could actually use when you're looking to buy a property or looking to sell a home. Either way, right? So, again, we're thankful that you're here and you're on our closing room chat. So, before we get started, I want to introduce a special guest. Today we have Paul Schmitt, senior mortgage broker at ClearPath Mortgage. Paul, how you doing today?
I'm doing well, Jesse. Thank you so much for the invitation to be on your podcast.
Well, awesome, and again, welcome to the closing room. I know today we're going to talk about when you're buying a house. There's a criteria called the 4 C's, and we're going to try to tackle them all. We may go through a couple. I know we have a lot on our plate today, so we'll do our best. I know you wanted to maybe start something differently. We talked about before we did this podcast. Started the podcast. We talked about maybe starting with one of the 4 C's in a different order, which is great. We'll do that. Again, we're going to talk about the mortgage approval process in this conversation. So let's get started, man. Let's talk about the first C. Which one are you comfortable starting off with?
Well, let's start off with credit. And before we jump into it, Jesse, I just want to remind you, I've been doing mortgages for about 13 years.
Thank you for reminding me, man. I'm sorry. I meant to tell you. Share a little bit about yourself. I'm getting excited because you're here. I'm getting excited about it.
That's all right. That's all right.
Ahead.
Yeah, about 13 years. I've worked for banks, and now I'm a broker. And what I really love is I have about 126 different lenders that I work with to really, I describe it as I am able to not try to put a square peg into a round hole. I can actually find a product and a service that really fits you. And that's the benefit of being a broker, and that's what I really enjoy about my job is really finding what's best for the client as opposed to just trying to find a product that maybe isn't best for them if you're limited. So,
Sure. Man, Paul, I got to tell you, 126 different lenders you could work with, that's got to be overwhelming. And I'm sure you probably work with just a handful that you're really comfortable with, I'm assuming.
Yeah, there's some that are like correspondent and they give better rates, give better, I would say, service or quicker service. But there's a lot of the different lenders that are really like niche lenders, and they only service particular needs or particular products. So it's not like one size fits all that they all offer the same type of products.
Gotcha. All right. Well, I got to tell you, look, I know a little bit about the real estate game, right? As a realtor's investor, I work with a bunch of different lenders as well, and I know the criteria to get them qualified into a property. And one of the big ones to start with, we're going to talk about credit. So tell me a little bit about the credit criteria for the processing part of it of approval.
Yeah, most definitely. And obviously when it talks about credit, credit is one of those things where we pull from all 3 bureaus. There's 3 bureaus, Experian, Equifax, and TransUnion. From a mortgage perspective, what we do is we toss out the highest score and the lowest score, and we go with whichever score comes in the middle.
Okay.
And what I usually remind people is your credit score, it is going to be different depending upon what you're getting it pulled for. So if you're getting your credit pulled for, let's say, a credit card or an auto loan or a mortgage, or if you're just looking at like an app or something yourself, you're probably seeing 4 different scores for yourself. So I always just let people keep that in mind if they use, like, let's say, Credit Karma or something. That score might be close or it might be very far off of what the score is for when we pull it for a mortgage.
All right. So don't use Credit Karma. And I don't know if we could throw that out there, that name. But okay, so Credit Karma, for example, let's just say that we end up running it. It could be different from a regular mortgage credit pull.
Yeah, you can use it. It can be a good temperature gauge because I'm saying like sometimes it will be accurate, but I've also seen it not be accurate. So
Gotcha.
If it's just something that you use, or if you have like a credit card that gives you like a rough idea of what your credit score is, you can use that to just kind of overall monitor, is it going up or is it going down? But I just remind it could be different for a mortgage.
Gotcha. So what's the difference between a good rate and a bad rate? So you pull my credit, you pull somebody's credit. What's considered a good rate, and then tell them a little bit what's considered a bad rate or a bad score, not rate, but credit score.
Yeah, usually whenever I see like 740 and up, I consider that really strong. And then if it's around maybe like 680, that's when we're looking at maybe a FHA instead of conventional, which we can dive into that. But really, with being a broker, I mean, there's lenders that if you're in the 500s, that there are options
There is.
to see if we can get you qualified for. The way
Okay.
it works is, and this has been in the news recently, is Fannie Freddie have recently dropped their requirement. It used to be about 620. They've dropped that as far as having a threshold of what is needed. But really, every bank still has their requirements of what they require, of what their risk tolerance is.
Okay.
So obviously, the better your credit score, or the higher your credit score, the better. And that really then translates into what you can get as far as for a rate. So your better the score, better your rate. The better your score. Also, if you're not putting down a large down payment, the better the mortgage insurance, or the less you pay on a monthly basis for mortgage insurance. So we can get into that later
All
on
right.
as well.
So you said 500s. Give me so what do you see? What are you seeing right now with your lenders that you work with? Right. What's the minimum on the 500 side?
A really goal would be to get to 580. That
580.
really opens up a lot of opportunities. Some will advertise that they go to 500 or even less than 500, but really the goal would be, let's get you to 580 if there's a way to get you to 580.
All right. And not to get too far off script, man, because I know we got your agenda on what we're going to talk about, but let's just say someone's in the 540s and you can't assist them. Any advice for them? I'm like, I got to get my score back up.
Well, I'd still love to see, like, is there a product or a lender? Because there are different lenders that would take it, depending upon the scenario, what's on that credit report. But I love to take a look at it and then come up with different ways of figuring out, all right, how can we get that credit score approved? Whether it's seeing if there's things that are on the credit report that can get taken off of it, or if there's just maybe you can be an authorized user on a credit card for somebody else, that would help bump up your score. There's different tricks of the trade to help increase your credit score.
Okay. What's too much credit? Is that a bad thing? Someone has just too many items open, too many credit cards. You know, when you guys are looking at this, I mean, is that a red flag? I don't know.
I've never seen it be a red flag, as long as, you know, they're making their payments on time and they're meeting at least the minimum monthly payment that is required for those different things.
All right.
Yeah.
Is there anything that could hinder? So let's just talk about someone that has a credit score of 700s, right? 720, whatever the case may be. Is there anything in that credit score, having that credit score 720, is there anything that could hinder a possible, trying to get them qualified for a purchase? Example, maybe they have outstanding student loans.
Mm-hmm.
You know, can that be an issue, even though they got a good credit score?
Well, yeah, that's when we're looking at their debt to income ratio, or their DTI, and that just takes a factor into that. That's later on. We'll talk about, like, their income versus what they pay on a monthly basis, and that can limit them for how much they can qualify for. When it comes to credit score, one thing that I do remind folks is there's a lot of people that are out there that they just don't have a credit score whatsoever, meaning they don't have any trade lines or any credit that's open. So when their credit gets pulled, it just comes back as nothing. And there are loans and there's programs that are available for folks that just don't have a credit score whatsoever as well. So I just like to make sure that those people realize there are opportunities. And then there are ways to quickly also, if you don't have any credit or a credit score, to quickly get a good credit score as well. So,
all right, cool. And I want to dive in the credit part of it, because I'll tell you, as a realtor, when I've got buyers, credit seems to be one of the biggest things. Credit and income, and we'll talk about income here in a bit. But on the credit side, when they come across, like, Jesse, I tell you, my credit score's in the 620, 640. And that's because I do have a mortgage late on my prior home now, or I have some collections that I'm trying to fight off. It's from the past when I was either in school or a medical bill or whatever the case may be. Is there anything there that perhaps lenders don't really look at? A medical bill that's a collection, or,
Yeah. And Jesse, that really all depends upon what type of loan that you're applying for.
Okay.
Like what you just mentioned is a great example. A lot of lenders and different types of loans don't look at, like, medical collections. So that's really good. And then when it comes to other ones that I see are probably student loans. That's what you probably see in the news the most, is like, oh, student loans are prohibiting people from buying homes. But from a student loan perspective, we usually just look to see what is the minimum monthly amount that's required, that's listed on the credit report. And if there's not anything, then we just use a small percentage of the balance to take into consideration for it.
Gotcha.
So I usually don't see a lot of people being held back from buying a home because of student loans, even though I would say that's probably the most common thing that I see in the news or just reading online of the theory on that's why people aren't buying homes these days.
Right. And I tell you, I've come across a lot of first-time home buyers, and most of them are younger folks that just came out of school and they have tons of student loans. I mean, I'm talking, it's out there, right? And so knowing that, yeah, they still got to qualify with that student loan, but they'll take in that minimum payment. That's what you guys are utilizing, right?
Correct. Yep.
Good. It's good to know that they can still buy a property because this newer generation, some of them drop out of school and they still have these student loans that they carry on. And we got to make sure that if we want to get them into the American dream of buying a home, even with these student loans there, we got to figure out a way to help them out. And I'm glad that you guys got those programs, and that's not really an obstacle anyhow.
It can be, but I just like to debunk that myth of like that's the main reason. Same way with if you have like credit card debt, what lenders look at is just what is the minimum monthly payment. They don't look at what the balance is. We just take a look at what does the credit report show as far as the minimum monthly amount. So,
is there too much credit debt?
Oh, there's of course if there's too much debt, there's too much debt. But that's where we're comparing.
Okay, but nothing that would hinder them from still qualifying for a property.
Well, it depends on what their debt to income ratio is. Okay. So that's the biggest factor that we look at when it comes to what do you make versus what do you pay on a monthly basis.
Right.
Because we want to make sure that the phrase that I use is we want to make sure that you own the home rather than the home owns you. And so we don't want you to qualify and get too much of a mortgage payment that you can't then live comfortably and live within your means as far as what you make versus what you owe on a monthly basis.
That's a good point, man. I tell you what, I've seen and I've worked with self-employed people, business owners that are buying these homes, and some of them carry $100,000, $200,000 in debt, and that may be there's some people that carry a lot more than that, but I've seen some that high, and they still qualify debt to income ratio wise, DTI wise, they still qualify, but I'm talking these credit cards are like maxed. Right? I mean, we're talking $60,000 on one card, $45,000 another. And I understand they use this credit cards for their business. I'm just, again, my question I asked a bit ago is that going to hinder them when they're buying a property? But as long as they qualify, you said, right?
Yes.
Which is the key. Yep. Qualifying them based on, we're not going to be too worried about how much debt they carry. Now, if they're not self-employed and there's just a youngster that just maxed out all their credit cards, can that be an issue?
Oh, most definitely. Yeah.
Even though they're qualifying based on debt to income.
Well, if the monthly payment and what they're paying as far as debt is too much, then they wouldn't be able to qualify. But that's our goal is to try to figure out, all right, what can we do? How can I advise as far as like what do we need to focus on paying off or getting rid of on a monthly basis so that we can then either qualify you for what you want or what you need to be able to move forward with the home buying process.
Perfect, man. Well, a lot of good information there, and we could spend all day talking about credit.
We could talk about credit for a long time, Jesse.
Because I tell you what, I've always said when I've got buyers on the buyer side, credit is a big deal.
Yep.
So cash, we always figure it out, but man, you can't hide credit. That score hits you, and it is what it is.
Yep.
Right.
Exactly.
So what can you do?
And you mentioned just another one of the C's is the cash. So we could just kind of briefly talk through that.
Yeah. Is there anything that I'm missing, Paul? Anything you want to add to the credit before we jump into cash?
No, I think obviously, and I just emphasize better the score, it ripples effects as far as the better towards the mortgage. You just get more options on loan, better rate, better mortgage insurance as far as what you pay on a monthly basis if you're not putting down that 20%. So really, when it comes to credit scores, there's ways around it to try to increase it and boost it. But yeah, it's definitely it's an important thing that is taken into consideration, and I like to just debunk the myth of people honestly usually just don't know where their credit score is at, and so that's why it's important just to speak with a lender up front to kind of just talk through where you're at.
All right, well, cool, very cool, man. Well, appreciate the info on credit. Let's dive into some cash. Why is cash important on a purchase?
I love to talk about cash, especially with first-time home buyers, because often they think, oh, I have to have 20% as a down payment, and I think that's we get that from maybe the older generation or people that have bought homes in the past is like you have to have 20%, and that couldn't be further from the truth. when it comes to the cash for a home, it really depends upon what type of loan it is. Like if you're eligible for a VA loan, you served in the military. That's one of the biggest benefits of a VA loan is you don't have to put necessarily any money down, which is fantastic. That's probably the most common. If you go with a VA loan, you're eligible. Vast majority don't put any money down. There's other loans like FHA, which is a 3.5% down payment. That's very common for first-time home buyers. There's conventional loans, which is 3% if you're a first-time home buyer, or maybe 5%. It's pretty common also with conventional. But Jesse, I guess that's the main thing I wanted to kind of debunk as well is when it comes to buying a home, 20% is a huge amount, especially with home prices these days. But if you can think and concentrate on 3%, 3.5%, and that kind of really shortens the amount of time that you need to save or the amount of gifts that you get from a family member to really make you eligible for getting a home sooner than later.
Okay. I'm going to dive in. Paul, man, I got to tell you that cash is also another big part, big piece for me as a realtor, as an investor, when especially when I have buyers, is credit. Cash is the second one, right? Because cash, if you don't have the down payment, if you don't have enough, it can make you break a deal as well, right? So let's talk a little bit about, or let's dive into some good stuff here. I want to talk about, what impacts your loan when it comes down to cash. So you mentioned 3.5% or 20%, right? So if I put 20% down, what does that look like on my loan? How does that impact it? Is it a better transaction, a better deal? Does it hold better value for me or for my client when they're making an offer? Or the 3%, is that still good? Or so
yeah, from a lender perspective, if you're able to put down, let's say 20%, it's a lot less risk in the eyes of the lender or the banks, whoever you're working with.
Yeah.
So that's when you do get better rates, and it's just all right. Approach it as a more well-qualified buyer. So I know, Jesse, probably you've seen this when you submit an offer and you have a buyer that you're working with and they're putting down 20%, that offer is looked at much stronger than if they're only putting down 3 or 3.5%. And so in the eyes of, if I'm selling a home and I see somebody saying, hey, they're going to put down 20%, it's like, all right, well, that's probably a well-qualified buyer, probably a strong buyer like that. That's just something that's an offer that I'd probably consider a lot more I guess better than if they're just putting like the minimum down. So that's probably the advantage is you just have a stronger offer. You do get better rates. And then in the eyes of a lender, you're just more well qualified if you're able to put more down.
All right.
So,
now you guys, as a lender, you ask for certain documentation.
mm-hmm.
One of them is always asking for either bank statements or other forms of documentation to verify that deposit, that down payment, right? That cash down payment.
Yep.
So walk me a little bit through that. What is that, as far as the documentation required?
Yeah, and Jesse, I love to do that when I work through at the very beginning of the process for the pre-qualification letter. Because here in Arizona, there's a box on there saying, has the lender reviewed asset statements? So whether it's investment accounts, a bank account, a retirement account, whatever that they plan on using for the purchase of the home, it literally on that document, it's saying, have you, the lender, have you laid eyes on and confirmed that this buyer actually has the assets and the money available to be making this purchase? And so, yeah, I do ask for wherever the money's coming from, can you send me a monthly bank statement so that I can just confirm that?
All right. What do you ask for if he's self-employed? Well, let's start off with the easy one. The W-2 employee, right? The guy that works for a business, works for an employer. What do you ask from that person?
Yeah, usually a pay stub that shows year-to-date information.
Okay.
Also W-2s. If they've been at that job, they probably have the W-2, for example, for like 2024, 2023. It just shows what they've made as far as income for the past couple years. And if they're self-employed, going back over to what your self-employed is, that's usually then when we get into like tax documents to be like, all right, what have you reported as far as income from your business and from what you do as far as for working for yourself?
Sure.
Yeah.
Are you asking are you asking for the full tax returns, or is there another way of, or are you maybe just a schedule? Most business owners have a schedule Schedule C or
I usually ask for it all just so I can see it because, a lot of self-employed business owners, they write a lot of stuff off, which is great for your taxes, but then it can hurt you as far as for qualifying for the loan because you might tell the government, hey, I make $50,000 a year, but really in actuality, you make $250,000 a year.
Right.
And so what we look at, since it's a government loan, if we're looking at like a Fannie Mae or Freddie Mac type of loan, those are government entity loans. So we look at what you report to the government as far as income goes. But Jesse, that's a whole nother conversation.
Right.
With being a broker, I love working with self-employed borrowers because there's so many loan options that are out there.
Yeah, I gotcha.
So there's ways around, like, sure enough, if you have a good accountant and they're writing off a lot of stuff for your business, you have so many loan options to kind of go around that and get a good loan as well.
Yeah, I got to tell you, my mind is right now going 1,000 miles an hour. I got to tell you because as a realtor, when I got buyers, and it's just to educate myself as well. I've been in the business for a long time, Paul. I got to tell you, but you're always learning something new because things always changing on the mortgage world, the mortgage side, right? And if you're not working with a strong lender or a strong loan officer, mortgage broker as yourself, man, you're not going to get educated and know the changes that are out there. But I always ask, I like to always get deeper into questions because it also helps me when I've got my buyers. So I'm not trying to be selfish here for myself, but I got to tell you, but I'm going to jump back into the self-employed tax return, right? So they give you this information, and you mentioned it right now. They report so much income.
Yeah.
But I know they may report this income of $200,000, for example, right? But you have to take away their expenses, and what's left is what you're qualifying them with. Correct?
Correct.
Right. So that's those are things that I want our listeners to know. You may be self-employed, and you may say, hey, I make X amount of dollars. But what you're looking at is really, after all expenses that you report, what is the bottom dollar?
Right.
Right.
But Jesse, that's why I'm saying that there are tremendous and lots of good loan programs that are out there. Not necessarily, I've worked at places that don't offer those loans, but that's once again why I'm a broker, because I want to find, all right, what's a good product? But we can look at, like, let's say a bank statement loan.
There you go. Yeah.
Where it's
absolutely.
like, what I do is I collect 12 months worth of your bank statements. And I don't look at what you write off or anything. I just look to see what's coming in the door and what's being reported into that bank account. And we determine then, all right, what is the income we can use based upon what we can see, those transactions that are coming into your bank account. And that right there alone, I've seen that just be an absolute game changer with a lot of self-employed borrowers. So let your accountant do their job. Let them write off everything that they legally can. But let's look at some other loan products that can help you out with actually buying that home that you want. So
okay, wow, good stuff, man. There's a lot more in there, and I don't want to derail this whole conversation just about cash, just for my own benefit here, because I'm like, man, I got to ask him this question.
Yeah.
All right. No, I'm not gonna.
That's
do
a
that.
whole nother podcast, Jesse.
All right. And you know what? I'm gonna invite you back because I know we got a lot of information to go through, and I want my listeners to know that it's not just about purchases today. We're talking about how to qualify for a purchase or what you're looking for.
Yeah.
On our next round, we're going to hit up refinance. Okay, we'll talk about that. So, all right, is there anything here on the cash? I know there's a lot more, but I'm going to leave it up to you if you want to talk about it or not. We got some time, but is there anything other than what we just talked about in the cash end of it that you want to talk about? Maybe closing costs when you're buying a property, maybe reserves. Anything here you want to tackle and kind of let our listeners know, like, hey, prepare yourself for this because you also need reserves, for example.
Yeah. Well, for example, if you just even Google like closing costs, if you Google it today, it's going to say it's going to be 3 to 5% of your purchase price, which is a crazy amount for where home prices are these days. So I like to debunk that as well. 3 to 5% of your purchase price is a lot. So I love being a broker and being able to help control some of those closing costs.
Sure.
And I'd say it's much closer to, I'd say, the 2 to 3 range as opposed to 3 to 5. The other thing is I just want to kind of emphasize you can get gifts from like family members to help you out with the down payment and the closing costs. So by all means, I always ask if you're short on assets. I do ask. I'm like, hey, do Do you have that uncle that you see once a year at Thanksgiving that just happened to have money and would be able to give you a gift to help you, get your foot in the door and to buy that home? Just keep that in mind. That is a viable option that a lot of people use is gifts from family members so that they can just make that first step to buying that first home. And it really kind of then snowballs from there as far as the opportunity to build equity, have a place, the home ownership thing is a real thing. And then, down the line, you might be selling that home and then buying another home, but you kind of see the value and the equity of that home grow to help you snowball into the next home.
So the gift, just so I'm clear as well, and the listeners are clear on this, the gift could be 100%. I mean, do they have to have any money out of their own pocket for that down payment, or can the gift be used 100% for the down payment?
It all depends upon the different loan programs. So every loan, I don't want to get into the weeds, but there's ways around it that we'll find that are within the guidelines of the different products. But
all right,
if you can get a 100% gift, let's talk and let's make it work.
All right, man. Thank you so much, Paul. I appreciate you. All right, let's talk about the third C, or the following one, perhaps is collateral. Right? What is the collateral?
The collateral, and you know this just being a realtor even better than I do, is it's the home itself, and that's really what we care about because that's what we're lending on. So
sure,
yeah. So from a lender perspective, that's why we usually do an appraisal. Sometimes we don't have to. We can get an appraisal waiver, which means we can skip the appraisal process.
Okay, hold on.
Okay,
don't jump any further because I haven't heard that one. You can skip the appraisal. I'm telling you, I'm learning something new all the time. So what does that mean? You could do an appraisal waiver. Is that because the property's we know it's worth way more than what they're buying it for, or what does that mean?
So when we get an appraisal waiver, usually it's because somebody putting down a good down payment, and the bank or the lender, whoever we're working with for the loan, realizes, hey, you're borrowing less money than what the home is worth by a significant amount that we feel comfortable with not even sending somebody out to confirm what the value is of that home.
So is there a percentage? Is it like 50% of the down payment of the house, or is there?
You can usually get it as low as 10 to 15 to 20% putting down, but it also depends. Like they're able to read and be like, all right, what type of neighborhood? What are the homes? What are the value of the homes in that neighborhood? Like the systems that check this are intuitive enough to know, like, all right, we know a rough idea of what the homes are in that area. So I would say it's definitely not a one-size-fits-all. It depends upon like multiple factors.
Okay.
But I always check, and that's once again why I love being a broker is I check with multiple sources as opposed to just one to be like, all right, is there a way to skip the appraisal? Because the benefit of that is appraisals do cost money, so it saves money and it saves time as well.
Sure.
So if you're able to skip that, it's a win-win for really everybody involved with the process.
All right. So here's a question people always ask me.
Sure.
They say, hey, what happens if I make an offer on this property and the appraisal comes in for less?
There's a couple of ways around it. Jesse, I'm sure you've seen these. First thing is usually we usually build a case to figure out, all right, did the appraiser do a solid job on determining what the value of the home is that they're reporting? So usually we'll submit a documentation just showing, hey, these are other homes in the area that are estimating to be about that same value, and then we ask them to do, it's a reconsideration of value is what it's called.
Okay.
Do that. Or, Jesse, you've seen this from a realtor's perspective, is you then maybe go back to the sellers and say, hey, the value of the home, according to the appraiser, is less than what the purchase price is, and you just kind of renegotiate the purchase price. Yeah.
And if the appraisal comes in much higher than the sales price, then what?
If the value comes in much higher than the sales price, that's when we're like, you're walking into this home with equity. Congratulations, that's awesome.
That's an awesome win, right?
That's a great win. That's always a good thing when I tell the buyers, hey, you're paying this home amount for this home, but it's actually worth that. So that's
for sure.
That's awesome.
Yep. I tell you, look, I'm gonna get my own plug on this one because obviously this is about Mr. Paul today and your company and and what you do. But I got to tell you, as when you work with the realtor, it's our job to really negotiate that sales price, right? So that when we do the appraisal, it always comes in much higher than the sales price. and it's a win for your buyer. It's a win for your client or your customer, in this case, the buyer, right?
For sure.
And it's a smart realtor or great realtor, however you want to look at it, man, knows how to negotiate that to get them to walk into a property with some equity in it, And so it's good to know that. So find yourself a good realtor. Always reach out to me, right? At the Moreno Group, we'd love to help you out.
For sure.
Paul, man, is there anything else when we talk about collateral that you want to, maybe I didn't ask, you want to mention?
Not necessarily. I really lean on, like, Jesse, your experience, because before you even submit an offer with your clients, I know you do your due diligence to be like, all right, what is this home really worth? So what is a good offer versus what is not a wise offer to submit? So that's where it's like leaning on your experience of knowing your neighborhoods, your areas that you target and that you're working with your clients. So from a lender perspective, usually it's, we do the appraisal to protect the money that's being loaned for the purchase of the home. But usually when you're working with a good agent like you, Jesse,
Appreciate it.
that work's already been done. And that's where it's like you just see the difference between an experienced and a non-experienced agent.
Well, I appreciate that, man. Thank you, Paul. Well, listen, I think we're kind of running short on time here. I know there's a lot more we want to talk perhaps about the capacity. Capacity, what that means in the 4 C's, but let's bring it back next time. Let's talk about it on the next conversation, next podcast here, and then we'll dive into some. I really want to talk about refinancing. Talk about maybe even dive a little deeper into these mortgage rates, what's going on with the market. And programs, the difference between the conventional, what it means, and FHA and VA, and anything else that you have in your wheelhouse that we could talk about. So we'll dive a little bit into that. Just want to wrap up with that and say, hey, Paul, thank you so much for your expertise. I truly appreciate that. Is there anything else before I kind of just wrap up and close up for us here?
Oh, Jesse, I appreciate it once again. Thank you. It's an honor to be here on your podcast.
Thank you.
I've known you for years. I speak highly about you, and I just appreciate your time.
Well, thank you again, man. I do appreciate you. You are a very wise man, and for all of us, for all these people listening on my podcast, if you have any questions, you got to reach out to Paul. Paul, if they want to reach out to you, man, is there a email address, a website, phone number that you want to just plug in and let them know?
Yeah, most definitely. So my website, it's clearpathmortgagebroker.com. It's powered by Expert Home Lending. So if you even look up Expert Home Lending, you'll see me on there as well. But I'm on Google, I'm on LinkedIn, I'm on Instagram, I'm everywhere. So
all right, cool. And I'm going to go ahead and plug that information in our podcast as well, so they'll have it there. Send me a DM on the side, and I'll be more than glad to give you his number, and they can reach out to you and have a conversation. But on your website and all your information, I'm sure it's going to have your contact number to reach out as well. Yep. So till next week, we'll tackle another big topic. If there's anything else that you guys want to talk about, like me to review, just let me know. Make sure that you please follow me on Instagram. It's the Closing Room AZ. So look me up, follow me there. And again, I appreciate your time, you guys. Thanks for hanging out with us today. Until next time, happy house hunting. And as always, set no limits.